Let's look at this set and forget strategy, the breakout trade for swing traders. Stick around. Hey guys, warm welcome to you. Thank you for joining me. All right, so many traders out there like to trade the markets but have other commitments, work, business, family, etc. Don't want to be stuck in front of the screens but like to have a selection of trades that are ready and primed to execute for them if the conditions are met. So this is a perfect thing for those people who are time poor but still want to be involved in the markets. Now, whether you want to do this with small size to get into the markets and to feel what's right for you and what works, or whether you're more comfortable with these, that's entirely up to you. Risk management is paramount. We'll talk about some of that in a moment, but let's look at the rules for this specific trade. So this is for swing traders, and we're going to use this on maybe stocks, indices, any kind of market that's trading. Forex as well, perfect. So the rules are, we are looking for a strong trend. Now, the trap that many traders fall into is to try to trade a breakout when the conditions aren't right. If you're trading a breakout in a range-bound environment or without the wind behind you, you're gonna have some kind of range depending on the time frame you're looking at, but without the pressure, kind of the tide rising behind you, you're always gonna struggle. So make sure you have a good, strong uptrend in the case of a moving to the upside. Then you want to have a consolidation or an acceptance of the level at highs. Now, some people say, well, now it's range bound. Yes, it is, but it's range bound after a drive. Just like a flag is range bound, after a drive, but it's the importance is the key trend beforehand, a nice strong trend. And you don't want this kind of moving back too low. You want it holding at highs. So not necessarily a bull flag, or you could do a bull flag, but some kind of consolidation up near to highs. A new acceptance of price, if you like. So we're a new level now for this stock and everyone seems to be comfortable with this level. And what you don't want as well is, something to add is many times where this market has broken out and failed. So you want it to have a specific level that it's not managed to go through. Very, very distinct line in the sand. So good, strong move, consolidation, distinct line in the sand. And then no upcoming news. Because what you don't want to do is be into a position that's kind of driven you into it based on news. So how do you set this position? So you use a stop limit order. Now, what does that mean? So a stop order is activated at a specific price. So let's say this price here is $100, for example, okay? You're looking to get long as the price breaks through there. So the idea of this is you're long on the breakout, you're looking to ride this breakout for 4 or 5 weeks, whatever it may be, close the position, but with a strict stop loss in, and stop loss we'll talk about in a moment. So how do you get into the trade if you're not going to be there? Obviously in front of the screen, as soon as it traded at 100, you'd buy it, you put your stop in, you're done. But if you're not at the screen, how do you put the trade in? So you use a stop order, okay, because that gets you into a trade. And a stop order basically says, hey, it's a buy stop. It basically says, hey, when the price hits 100 or more, get me into the market. And let's say you're doing 1,000 shares, for example. You're talking about shares. It could be anything. Could be pounds a point, could be CFDs, whatever. So you're buying 1,000 shares as it hits 100, or as it hits 101. It'd be 100 in this case, you've got a buy stop. Now, what you don't want in this case, this is where you would use a buy stop limit. So a buy stop limit order basically says, hey, rather than just triggering this wildly, so let's say it suddenly gaps up the next day at 103, you're long at 103. Now that might be fine if you're coming out of a short position, but getting to a fresh position, you don't want that. So if you can, depending on which broker you're using, you want to say, hey, I want to buy stop, but I only want to pay up to, say, 100.05. And you can allow it and put the order in, and that basically says, hey, this is the limit. So what it does is it puts a limit order in. When the stop is triggered, it puts a limit buy-in at 100.05. If it's 100, you get filled at 100. If it's 101, you don't get filled unless it comes back and fills it. So that's a little extra you can add to it. You don't always have to have that, but it stops you perhaps getting filled if it gaps up overnight and it's a stock, for example. You don't really want it if it's already ripped up high. It's another fresh trade. So that's the trade. And then you're going to put an attached order, which is also going to be a sell stop. So basically when that's triggered, you're going to put a sell stop in, and the easiest way to put this is just to have it literally very clear under that range. It's super simple, because what you don't want to do is you don't want to be stopped out kind of straight away. Now you may well, once you're triggered and you can get back to the screen, then want to adjust that. Of course, that's got to be acceptable risk for you based on your position size, etc. But at least you're in the position then. You've already calculated the position and you know that the computer, if you like, is sitting there waiting for these attributes to occur, and then you're going to get in the trade. So when you're in the trade, your stop's in, so you're protected against the heavy kind of reversal. But what it means is that once you're in, you come back, now you can start to adjust it and go, right, does my stop need to be tighter? You know, this and that and the other. It just gets you into the trade. Another way of doing it is to use a small position size just to get you into the trade, to alert you to the breakout. 100 shares, for example. I'm in the trade, I'm in the breakout, right? Now I need to go to the screens and manage it and decide whether to buy more, whether to do this, whether to do that. It's just a nice kind of way, especially when you've got multiple trades set up like this. With that small size kind of strategy, you set up multiple trades with it, you get into various positions, and they make you so small they're meaningless for your account size. But what it does is it highlights how that's doing that. It's a little bit more attention drawing than a normal alert. A normal alert, you might just discard it and forget it, especially if you've got many of them. But now you've forced to have skin in the game, you start to assess it a little bit differently. So it's not a bad way of doing things. So that's the breakout trade, guys. And you've got to make sure there's no up and coming news as well. So you're literally looking for the strong move, the consolidation, and looking for a break above the high. That's going to get you into the trade. And the thing is, if you're on a breakout trade, don't waste it. You know, if it's a genuinely good, strong breakout, you will get a good move from it. So temptation might be 2 days to close it off. Of course, if it starts to pull back and come back down, you might want to dump the thing. That's, again, parameters and strategy that you can employ and decide what to do. But if you're in a good volatility expansion breakout trade, you know, these things can run and run and run, especially if you've had a good trend, you've had a consolidation, and it just continues to go again. That's real textbook, you know, strong demand coming in. So buy stop, use a limit if you can on attached to the stop so it doesn't fill you at a really bad price. Get in, automatically attaches a sell stop, so you're long with a sell stop. That protects you, and then you can amend and adjust it when you're in the trade. All right, guys, take care. See you next one. Bye-bye.